On the surface, the US economy looks strong. We're seeing positive GDP growth, low unemployment, and a soaring stock market. But at the same time, the entire system is being hit with some pretty serious shocks. So the big question is, with all this chaos beneath the surface, why hasn't everything collapsed?
And this quote really sums it up. Think about what's been thrown at the system lately: chaotic tariff policies, government shutdowns, major tax overhauls. These are not minor tweaks. These are significant disruptions to a very complex machine. So you have this real contradiction. On one side, you have these powerful economic shocks, but on the other, you've got headline data that seems to suggest everything's fine. So how can both of these things be true at the same time? Well, to figure that out, we have to dig a lot deeper than the headlines.
We're going to break this down into four key areas to see what's really going on. We'll look at the AI spending boom, what the trade data is actually telling us, the real state of the consumer, and the hidden role the US dollar is playing in all of this. Then we'll get to a final verdict. So first up, the AI spending mirage. There's a narrative that massive investment in artificial intelligence is propping up the entire economy. But we have to ask, is this tech boom just painting over some much deeper cracks? You see a number like this, positive 4.3% annualized GDP growth, and it looks fantastic. A lot of that strength is being attributed to the trillions of dollars pouring into AI infrastructure, things like data centers and semiconductors. But here is the catch. While that AI spending added about 2.5% to GDP growth, that gain was almost perfectly offset by something else. At the same time, businesses were rapidly selling off their existing inventories, and that counts as a negative in GDP calculations. So the net effect on overall investment was basically zero. The key takeaway here is that the AI boom isn't actually adding new investment to the economy. It's really just replacing the economic activity of building up inventories. And that's a pretty fragile situation because if that AI spending slows down, that underlying weakness is going to be exposed very quickly. Okay, next, let's look at our trade balance. On paper, the numbers might make you think that some of these controversial tariff policies are working. But when you look closer, the story is a lot more complicated. Now, the headline figures look pretty good. We're importing less and we're exporting more. And according to standard economics, that should be a huge positive for GDP. But the drop in imports isn't what it seems. It's not happening because of some big surge in buying American. It's happening because businesses are simply burning through the massive stockpiles they built up before all the tariff uncertainty. It's a move based on managing risk, not on fundamental strength. And the export story is even more telling. Out of a $26 billion increase in exports, an incredible $18 billion of that came from selling our gold and silver. We're not talking about a boom in manufactured goods here. We're talking about shipping our precious metals out of the country at an incredible rate. This is not a sign of a healthy, productive economy. It's an indication that other countries are diversifying away from the US dollar and into hard assets. It's a strategy that can work in the short term, but it is absolutely not a sustainable path to long-term growth. So that brings us to the American consumer. Consumer spending has always been the engine of the US economy. And while spending is still happening, what people are spending on and who is doing the spending tells a much different story. First of all, the spending growth isn't broad-based. It's heavily concentrated among the wealthiest households who are benefiting from rising asset prices. This isn't a sign of widespread economic confidence for the average person. And second, just look at where the money is actually going. The growth isn't in discretionary items like vacations or new electronics. The real growth is in non-discretionary, essential categories, healthcare and pharmaceuticals. And this isn't spending that comes from a place of optimism. It's driven by necessity. Our population is getting older, there's high demand for new drugs, and frankly, there's fear. People trying to use their health insurance while they still have it. This is spending out of need, not confidence. Now we get to the final piece of this puzzle, and it's the one that really reframes everything else we've talked about. And that is the hidden role of the US dollar.
You see, during this same period of apparent economic strength, the US dollar actually fell by more than 10% against other major world currencies. That is a very significant decline, and it quietly distorts all the other numbers. Let's just take the stock market. In US dollars, it appears to be hitting record highs. This makes wealthier households feel richer and they spend more. But if you measure the value of those same stocks in other currencies, the market looks flat or even negative. Their actual global purchasing power hasn't really increased. And that weaker dollar also helps explain those trade numbers. It automatically makes our exports look cheaper to the rest of the world and makes imports more expensive for us. So while it juices the trade numbers on paper, what it really means for the average consumer is that goods are just getting more expensive. So after peeling back the layers on AI, trade, and consumer spending, we come back to that central question. With all these issues hiding just beneath the surface, why hasn't everything just broken down? And the answer seems to be inertia. The US economy is just so massive and so deeply intertwined with the global financial system that it simply doesn't move quickly. Its sheer size acts as a giant cushion, absorbing shocks that would absolutely crush smaller economies. But that's a double-edged sword. The same inertia that prevents rapid collapse also means that turning this massive ship around is an incredibly slow and difficult process. The very thing that provides stability also makes it very hard to fix when things start going wrong. And that leaves us with a final, pretty sobering question. Are we looking at an economy that's truly resilient, one that can absorb any shock that's thrown at it? Or is it just an economy that's too big to fail quickly, with its decline being masked by misleading numbers and its own immense size?